All right, welcome back, everybody. Today is Monday. We are still working in chapter 6 today. We'll probably be working on chapter 6 the remainder of the week. We might finish it up Wednesday, and then start on our exam review on Friday. Um, I haven't set the date for the exam next week yet. It's either going to be Wednesday or Friday. I will let everyone know once I have that set in stone. But just know for sure that next week we do have a midterm exam on chapters 1 through 6. So um, everyone else just keep up with their Connect homework. I think chapter 6 will be due this Sunday. Chapter 5, if I'm not mistaken, was due this past Sunday. So hopefully everything's going well with that. I'll have the grading caught back up hopefully by this evening or later in the next couple of days, next day or two, so that way we know where we're standing leading into the midterm. Um, so let's go ahead. We went through the PowerPoint on Friday, and I believe half of Wednesday. So we've covered the PowerPoint already for Chapter 6. We know Chapter 6 is dealing with proprietary funds, right? Um, the first 5 chapters focused on just a review of the overall the financial statements we see on government wide and on the fund level, and then we focused in pretty heavily on the governmental funds. So we've done focused on governmental funds. We know they operate on the modified accrual, the current resource measurement focus. They record expenditures, and we know there's 5 of those funds. We have the general fund, which is going to be only one of those. Every government has to have one. We have the capital projects fund, special revenue fund, the permanent fund, and we have the debt service fund. We know what each of those functions are for. We know that the special revenue fund receives more attention from GASB because they have to be restricted or committed. The other fund balances have to be assigned, and general fund is the only one with the unassigned balance. Um, Financial statements, we know what financial statements we have on those. So let's move on. Let's move on to proprietary funds now. We know there's 2 proprietary funds. We've been working on this last day and a half. We know there's the internal service fund and there's the enterprise fund. Enterprise fund primarily services those outside of the government. Internal service fund primarily services those within the government. We know these 2 funds operate on the accrual basis of accounting, the economic resource measurement focus. So therefore, we're going to be matching revenues with expenses. We are recording depreciation expense, and we are focusing on profit, right, on income generation or net income. We know that the 3 funds that we, or financial statements that we have to have accompanying the proprietary funds is going to be the statement of net position, the statement of revenues, expenses, and changes in fund net position, and then the statement of cash flows. Um, we know net position is broken into 3 categories. We have net investment in capital assets. We have unrestricted and restricted, with the unrestricted being the plug. Net investment in capital assets starts with capital assets. We back out accumulated depreciation and any outstanding debt related to those capital assets. And we know the statement of cash flows differs from that of FASB. We know GASB has 4 categories as opposed to 3. We still have the operating, has to be prepared on direct method as opposed to the option of indirect or direct with FASB. And we have 2 financing sections as opposed to 1. We have the non-capital financing and the capital financing, and then we have the investing. So that's just a little overview. I kind of like doing that, starting classes out so we know where we've been, know where we're going, and we just hear it again because it never hurts to just hear it again. So let's get deeper into these proprietary funds. So like I said, we've pretty much covered what they are, how they report their assets and liabilities and revenue. So let's get into them a little bit deeper now. Um, let's start off with this little chart here. This will be a good way to start off with. Kind of the same thing we just did a little bit, but we'll just go a little more in depth again one more time. So on the left, we got the fund name here, and then moving to the right, we just have the term, the description, and what type of activities go on along in each of these funds. So let's just start with the internal service fund because it's listed first here. We know it operates on the accrual basis of accounting. We've established that. Economic resource focus, we know that because it's on accrual base, so we're dealt with economic resource focus. We do not record budgets, we do not record encumbrances. Fund description, funds used to report activities that provide goods and services to other funds, departments, or agencies on a cost reimbursement basis. They are used when the government is the predominant user of the goods or services. So we know that the Internal Service Fund primarily services the internal government. The fund term has an indefinite life. The internal service funds are created by the government and exist at the discretion of the government. Next, the enterprise fund, same thing, accrual basis, economic resource measurement focus. We do not record budgets and we don't record encumbrances. So they're the same when it comes to that regards. The description of the enterprise fund, funds used to report activities in which users are charged a fee for goods or services. They are appropriate when individuals or businesses external to the government are the predominant users. This has an indefinite life for the fund term. Enterprise funds must be maintained if debt secured solely by user charges. Laws require that costs be recovered through the user charges, or government policy requires setting charges to recover the cost of providing the good or service. So we know that, right? The enterprise fund has to be established if one of those three cases are present. And remember, there's something that was familiar among all three of those things. It was if they were backed by fees or charges, right? So obviously that's how the government it receives fees and charges through an enterprise fund. So it makes sense that they have to have it if one of those three situations are at hand. So that's just our little review with the two proprietary type funds. So straightforward. I just want to point out one thing here. With these being proprietary type like funds, although it is still governmental funds, but it's proprietary type funds at the fund level. For the most part, governments have kind of adhered to FASB because it's for profit, because it's the same, it's accrual accounting, and you're measuring revenues with expenses and recording depreciation and stuff of that sort. So they've kind of adhered to FASB. So what GASB has done here recently is clarified the practice by incorporating specific FASB standards into the GASB codification. Remember, because we have the accounting standards codification for both GASB and FASB, right? So pretty much what FASB's done is to help the reporting of the governments better suit the needs of the users of these statements. They've just incorporated some of the pronouncements from FASB into GASB. So that's all we're saying here. And among those are some of the topics incorporated from FASB standards into GASB. Deals with error corrections and changing in accounting principles and estimates. We know error corrections are dealt with, remember, as beginning of period retained earnings. Remember, that's where they're charged to. If we find an error, say we're in year 2020 and we find a mistake in year 2019, we're going to charge that at the beginning of the period retained earnings, right? Changing accounting principles and estimate. We know the changing accounting estimates is dealt with prospectively, just in the current period and prospectively. Accounting principles have retroactive application, so we have to change whatever comparative statements. Contingencies, we know the rule with contingencies, foreign currency transactions, current asset liability classification. So once again, that's just current, non-current. And the equity method for investments in common stock. Because we know when investors invest in the companies, they can either do it at cost, equity, or they have control, right? So they've just pulled that equity method. All right. Let's see here. Just bear with me for a second. So just get familiar with these. I'm pretty sure these are the statements next. Okay, we're going to get into more journal entries. So we're going to get into an illustrative example for the internal service fund, which is, in this case, they're using it as a supplies fund. So same thing we did last time with the other chapters dealing with the illustrative examples. We're gonna do the same thing here. So just kind of bear with me here. I'm just going to do a little bit of reading and then that just set up so we can understand what's going on in these journal entries. And once again, I just want to point out to everybody that everything we're going over is directly from chapter 6. I don't know if people have read the chapter or not. Whether you have or haven't, I still think it'll be a great review, and it'll help us just see some of these transactions that we would expect to see. So let's just go ahead and get into this illustrative case. And once again, this is for the Internal Service Fund, and this is a supplies fund, is what this government has set it up as. So let's assume that the administrators of the Village of Riverside obtain approval from the Village Council in early 2020 to centralize the purchasing, storing, and issuing maintenance, office, and cleaning supplies in an internal service fund, known as the Supplies Fund. So a payment of $596,000 cash is made from the general fund that is not to be repaid by the Supplies Fund. Of the $596,000, $290,000 is to finance capital acquisitions, and $306,000 is to finance non-capital acquisitions. Additionally, a long-term advance of $200,000 is made from the Water Utility Fund for the purpose of acquiring capital assets. The advance is to be repaid in 20 equal annual installments with no interest. The receipt of the transfer and the liability to the Water Utility Fund would be recorded in the Supplies Fund accounts in the following manner. So now, once again, this is for all the money that we just talked about coming in, right? From the Supplies Fund, from the Water Utility Fund that we have to pay back in equal installments without interest, and then also the transfer in from the general fund, okay? So obviously, this is the Internal Service Fund receiving that money, right? So obviously, we're debiting cash, asset. It's an asset. It's an original debit. It's going up, right? We're bringing money in. We're going to credit the transfer in from the general fund, 596, because remember, transfers in other financing sources is its credit. So that's the transfer in. An advance from the Water Utility Fund of $200,000. So we've recorded the money coming in, and we've stipulated the sources in which it's came, right? Okay. So next, to provide some revenue on funds not needed currently, $50,000 is invested in marketable securities. So obviously, if we're purchasing investments, we're just going to debit investments because it's an asset. It's going up. So we're increasing our investments by $50,000 and crediting cash $50,000 because we bought the investment. So it's money going out. We have to reduce the asset. It's straightforward, right? And a lot of these entries are going to be very similar than what you're going to see in your intermediate and your principles courses. So this should be a little more familiar with the typical recording of these transactions. Now let's assume that in early 2020, a satisfactory warehouse building is purchased for $350,000. Now $80,000 of the purchase price is going to be considered as the cost of the land, okay? Necessary warehouse machinery and equipment are purchased for $100,000. Delivery equipment is purchased for $40,000. If the purchases are made for cash, the acquisition of the assets would be recorded in the books of the Supplies Fund as follows. Okay, so obviously, once again, remember we're purchasing supplies now and assets. So we bought land at $80,000, so we're going to incur land for $80,000, right? We have the asset of the land. Building $270,000, because remember we proportionately split the cost of the $350 between the land and the building, as we have to do when we purchase a plot when they're combined. So the land we debited at $80,000, we debited the building at $270,000. We bought machinery and equipment for the warehouse for $100,000 and equipment for delivery for $40,000, and we paid cash for all of it. So obviously we're gonna credit cash for $490 because that's the sum of all of these combined. So really, we've just debited all these assets, right? They're assets, they're debits, so we have to debit them, credit cash. So that's we're just something we've used to seeing this in all our other classes, right? Nothing's changed. It's pretty straightforward. So supplies are ordered to maintain inventories at a level sufficient to meet expected usage. No entry is needed because proprietary funds are not required to record encumbrances. So when we order something from a proprietary fund, we don't have to do that encumbrance entry, right? We wait till the liability actually hits us, right? Just like any other thing. We're not concerned with encumbrances. So during the year, supplies are received and related invoices are approved for payment. in the amount of $523,500. The entry needed to record the asset and the liability is as follows. Okay, obviously, supplies now, we've received those supplies, so we're going to debit inventory of supplies because it's an asset for $523,500 and credit accounts payable for $523,500 because now we've incurred the liability, right? We've received those supplies, so we're debiting them for the asset and crediting the liability, showing that we owe for what we just received. So the supplies fund accounts for its inventories on the perpetual inventory basis because the information is needed for proper performance of its primary function. Accordingly, when supplies are issued, the inventory account must be credited for the cost of the supplies issued. However, the amount charged to the fund purchasing the supplies includes a markup, with the result that the receivable and the revenue accounts reflect the selling price. The markup above cost should be determined on the basis of budgeted expenses and other items to be financed from net income. If the budget for the Village of Riverside Supplies Fund indicates that a markup of 30% on cost is needed, issues to the general fund departments of supplies costing $290,000 would be recorded by the following entries. Okay, so once again, what we're saying here is we're gonna supply some inventory, some of our inventory of supplies to another fund, right? So what they're saying is first we have to incur our cost, right? Because we're going to be tracing the cost of what we're providing, right? So first thing we have to do is we have to incur our operating expense, the cost, right? And that's obviously what it costs us. So that the cost of $290,000. So the internal service fund will debit operating expenses, cost of sales and services for the $290,000, and credit inventories of supplies of $290,000. We understand that, right? We've incurred the cost of the inventories and we've relieved inventory, right? Now the next entry, the back end of that entry, is we're going to set up a due from the general fund of $377,000 and credit operating revenues charges for sales of services of $377,000. And we get this because it's the $290,000 the cost times the 30% markup that we need, which is obviously about 130%. So times it by 1.3 and it'll give us 377. Pretty simple, right? So we're recording our cost incurred, reducing our inventories, and then we're going to set up our due from the relative fund, in this case the general fund, and then we're going to credit the revenues that we received on the markup cost, right? And remember that's done because it's planned through the budgets. To be able to, because remember this is on a cost reimbursement, so in order to be able to justify what they needed to be able to maintain this fund and do what they needed to do, they had to mark it up 30%. Pretty simple, right? You just have to remember, incur your cost, relieve your inventory, and then set up the due from and your revenue, which is, it's the same as we know on a perpetual, because remember they say they operate on a perpetual inventory method. Same thing we would see in the for-profit, right? We make our sale. What happens? We debit cost of sales, right? Cost of goods sold. We credit inventory. Then we debit accounts receivable, credit revenue. So same thing here. It's just a little bit different word, different terminology of the term, right? So not bad at all. It's the same thing we've been seeing in all of our other accounting courses. Okay. Next, it says during the year, purchasing expenses totaled $19,000, warehousing expenses totaled $12,000, delivery expenses totaled $13,000, and administrative expenses totaled $11,000, and they're all incurred. The government has chosen to separate operating expenses into three categories, okay? Cost of sales and services, administration, and depreciation. So they've split up the cost of the expenses into three categories. If all liabilities are vouchered before payment, the entry would be as followed. So let's go ahead and look at this next entry here. So once again, if these entries are vouchered before payment, meaning if we're going to record them before we actually set the payment, then obviously that means we're going to set up the liability, right? So operating expenses are going to be debited for cost of sales. Let me just make this a little larger here in case people are having trouble seeing it. So operating expenses, cost of sales and services for $44,000, and that's for the purchasing expenses, the warehouse expenses, and delivery expenses, right? Then we're going to debit operating expenses for administration of $11,000 and credit accounts payable of $55,000. So remember they said that they categorized their expenses into three categories: depreciation, and cost of sales and services, and administration. So that's why we're grouping it together like this, because they want to keep track of where those expenses are, right? Makes sense here. Okay, if collections from the general fund during the year totaled $322,000, the entry would be as debit to cash at $322, credit due from general fund at $322. Simple, right? The general fund paid us the money they owed us. It was originally set up as a due from the general fund, so obviously now we're receiving the money, so we're debiting cash. It's an asset that's going up, and we're reducing our due from the general fund, which is also an asset. That's why we're crediting it, to keep it intact. Okay, assuming that payment of vouchers during the year totaled $567,500, the entry would be made as follows: we debit accounts payable $567,500, credit cash $567,500. Simple, right? We've seen this a million times in our past classes. We're just paying a liability. Debit accounts payable, credit cash. So we're debiting accounts payable because it's reducing our liability, crediting cash because it's money going out the door, it's reducing our asset. Okay, the advance from the water utility fund is to be repaid in 20 equal annual installments. Repayment of one installment at the end of the current year is going to be recorded as followed. Remember, it's non-interest bearing. We're not, so interest is not an element here. They just want the principal back in those equal installments. So obviously, if we're going to be paying the advance back to the water utility fund, we're going to debit advance from the water utility fund of $10,000 and credit cash of $10,000. Pretty simple, right? Okay, at the time depreciable assets are acquired, the warehouse building has an estimated useful life of 20 years. The warehouse machinery and equipment have an estimated useful life of 10 years, and the delivery equipment has an estimated useful life of 10 years. Further, none of the assets have any expected salvage value. So under these assumptions, straight line depreciation of the building would be $13,500 per year. Depreciation of machinery and equipment would be $10,000 per year, and depreciation of delivery equipment would be $4,000 per year, right? So if that's the case, then we need to record our depreciation expense, right? Because these proprietary funds record depreciation within the funds. So we're going to debit operating expenses for depreciation of $27,500. And then we're going to credit accumulated depreciation for the building for $13,500, credit accumulated depreciation for the warehouse equipment of $10,000, and credit accumulated depreciation for equipment for the delivery equipment of $4,000. So now with this journal entry, we've recorded our current period's depreciation expense and credited the relative accumulated depreciation accounts, right? So what's this entry accomplish? It makes us incur the depreciation expense, but it also reduces the carrying value of the assets on the balance sheet, right? Because they're carried at cost, which is cost less accumulated depreciation, right? So that's the net book value. So that's what that entry accomplished. Okay, organizations that keep perpetual inventory records must adjust the records periodically to reflect shortages, overages, and out-of-condition stock disclosed by physical inventories. Adjustments to the inventory account are considered to be adjustments to the warehousing expenses of the period. In this illustrative case, it is assumed that no adjustments are found to be necessary herein, so we're just no adjustments here. Interest income is earned and received in cash on the investments purchased at the beginning of the year. Remember, we bought that investment in marketable securities for $50,000 of idle cash just to try to produce some revenue off it. So now we're receiving some of that interest. So we're just going to debit cash for 3,000 and credit non-operating revenues of interest, right? Because we're getting cash, it's an asset, it's going up, and it's a revenue for non-operating revenue for interest, right? For 3,000. All right, assuming that all revenues, expenses, and transfers have been properly recorded by the entries illustrated, the nominal account should be closed as of December 31st. So once again, we know no matter what, we have to have closing entries, right? And in this case, it's the nominal accounts, right? The revenues, expenses, and what else? There's one other lingering thing. Revenues, expenses, dealing with proprietary funds, and
other financing sources.
Your transfers, absolutely. So we have to close the nominal operating accounts plus which includes transfers. Good job. So let's just assume that all the entries have been posted correctly, right? So now we're just going to do our closing entry, and we know this is just the opposite of what it should be, right? We're just reversing our entries. So operating revenues, charges for sales and services throughout the period were $377,000, so we want to debit those. Non-operating revenues of interest, remember, off that investment of $3,000, we want to debit that. Transfers in of $596,000, we want to debit that. We want to credit our operating expenses, cost of sales and services of $334,000, credit operating expenses administration of $11,000, and credit operating expenses of depreciation of our fixed assets of $27,500. And then you notice we plug to net position again. So same thing with government, we plug it to net position when we do our closing entries. Okay, now recall that net position of governmental funds is termed fund balance, right? And it's classified within 5 categories. So that's the governmental funds. We have the fund balance was in five categories, right? We had our non-spendable and our 4 spendable categories. Well, in contrast, the excess of assets over liabilities and proprietary funds is termed net position, and it's classified in 3 categories. We know that, right? What are the 3 categories?
Would it be the restricted, unrestricted, and net investment capital assets?
Absolutely. And what's the formula for net investment capital assets?
It's the capital assets minus accumulated depreciation minus related outstanding debt.
Awesome. Not bad at all, is it? And just to point out, most of the time with these proprietary funds, like the internal service funds, you most likely will not see anything unrestricted. But just know unrestricted is from outside. Strictly outside is unrestricted, right? But just to know that we usually won't see unrestricted or restricted. So if we do, it's just know it's from outside. So we know that the unrestricted is a plug once we find net investment and capital assets and restricted, right? The residual is going to be our plug. Okay, let's just talk again, just since we're on internal service funds. Remember we talked about risk management activities with health insurance. If they wanted to sponsor their own health insurance, a government, remember they have a choice. They can either account for it in an internal service fund or in a general fund, right? Depending on how they want to go about it. Just remember, if it is operated, if the health insurance, the health insurance is operated within an internal service fund, then the transfers of the premiums between funds is going to be treated as a revenue for the internal service fund, and then as an expenditure and expense in the relative fund being charged. So just keep that in mind. And and the price is going to be based upon just a realistic cost that'll break even over the whole end of the term of the premiums or the expense of the policy. So that's pretty much what it is, dealing with the risk management activities. Just know, main thing is know you can either account for it in an internal service fund or in the general fund. That's the main thing. Implications for other funds and dealing with the internal service funds. Internal service funds are optional for governments to use. So it kind of creates a little bit of an issue when dealing with just the overall picture of the governments in general. So obviously, if we know that, for example, this risk management activities, if a government has an option to account for something in the internal service fund or the general fund, if one government accounts for it one way and another accounts for it another way, then it kind of might give us a little bit of an issue when trying to compare the financial positions and the strengths of governments, right? Because they're accounting for stuff different. Well, that's one thing that can come up about. And another thing is we know that the internal service fund is used primarily for what, servicing other sectors or other funds within the government, right? And it's usually done on a cost reimbursement basis. Well, we've seen how an example of how dealing with different elements of the budget and stuff, we try to determine what costs we should have when charging these services in our funds between the governments, right? In this case, it was the 30% markup, if you recall that entry. What issue we can get into with dealing between the general fund and internal service fund, because that's basically where we're going to be charging to for the most part, because it's their general activities where general stuff is charged. So if the internal service fund is going to overcharge a general fund on their cost reimbursement, then obviously what's going to end up happening is the expenditures are going to be overstated in the general fund, and your revenue is going to be overstated in one, the expenses, and overstated revenue in the other. So what's going to happen is your fund balance, you're just going to shift your fund balance from one fund to the other by doing that. Then, so pretty much you're going to be removing that unassigned fund balance, the residual fund balance, just slowly by each exchange transaction, slowly depleting the one in the general fund and building the one in internal service. Same thing. If you're charging two less, your fund balance, your net position is going to be shrinking in your internal service, but growing in your general fund. So that's why we want to equal cost reimbursement, so we keep the funds intact. Does that make sense? Because we don't want to distort either fund. But does that make sense how that can happen? And that can also cause some issues between comparative purposes along governments, right? Or amongst governments. So this just this is for future reference and future points. We'll get to it, but that is where enters government-wide statements. That eliminates the issue of comparability. That's another thing GASB really stressed on the government-wide statements when they brought those into full effect. So I just wanted to point that out. Some issues that could come about if they're operated incorrectly, right? So that's why I wanted to point that out. So that's it for the internal service fund. We'll still look at the balance, or the financial statements that accompany it after we go through the enterprise fund. We'll get started on that in a minute. I just want to point out, just for proprietary funds for the balance sheet, it adheres to the same major, non-major funds as we've seen in the governmental funds. So the fund level basis financial statements do carry over some of the rules from the governmental funds, even though we're on a different accounting system. So expect to see that you're going to have your non-major and your major enterprise funds, right? And for dealing with proprietary funds. However, your internal service funds, if a government has 10 internal service funds, they're going to combine all those into one internal service fund column, as if they're all non-major ones, right? So that's important to know on that net statement of net position. All internal service funds are going to be accounted for within one fund, and then besides that, the major enterprise funds and then non-major enterprise funds column. Makes sense? Okay. So let's talk about enterprise funds now for a minute. So we know that enterprise funds are different from internal service funds in that they service the sector outside of the government, right? Like the citizens and your basic public. We know that enterprise funds, a lot of times, remember they're going to build major capital projects as well, have major capital assets, right? But we're not going to account for those within a capital projects fund like a governmental fund, right? We account for that within both the internal service fund and enterprise fund, right? But what the governments usually do when they build buildings and bridges and roads, how do they finance it?
Through bonds or taxes.
Right, through bonds usually is how they usually do most capital projects, or like you said, earmark taxes for specific purposes. What I'm getting back at is, recall that the enterprise funds can have either revenue bonds or general obligation bonds. Remember, because they raise revenue from for building their capital projects or fixed assets. General obligation bonds, remember, are backed by the taxing authority of the government. You usually get better interest rates on it and stuff of that. It's better financing. Revenue bonds are going to be backed solely by revenue, right? By the power of the enterprise fund producing revenues on exchange-like transactions. Not going to get as good of an interest rate. Remember, sometimes enterprise funds will use general obligation bonds just for formality of getting the better interest rate. And if they do so, they still account for it within that fund, right? When is the only time that we would account for the debt and the government-wide statements as opposed to in the enterprise fund from a bond proceeds? When would we do that? Only if the government fully intends and has the ability to pay it. Only, and it's that they fully intend on doing so. So only if they're like, hey, 110% we're paying this, don't worry about it, we're putting it in the government-wide statements, right? And then the expense is going to be noticed in the statement of activities in the government-wide, and it's going to be in a long-term position for the statement of net position, right, government-wide. But only if the government says we're going to totally pay them, we're going to totally back it, and we're totally committed to paying it. Besides that, it's going into the enterprise fund. Okay. So let's just go through a couple examples here. Okay, same thing here. I'm just going to go through some examples, same way we did on the Internal Service Fund. So it says, it is common for governmental enterprises, especially utilities, to report restricted assets. In this example, the restricted assets include $55,000 set aside for future debt service payments as required by a revenue bond indenture agreement. Budgets are not recorded in enterprise funds. We know that. We went over that chart. When utility customers are billed during the year, appropriate revenue accounts are credited. Assuming that during 2020, the total bills to non-governmental customers amounted to $975,300. Bills to the Village of Riverside General Fund amounted to $80,000, and all revenue was from sales of water. Then the following entry would summarize the results of what we just said. So obviously, for the stuff that we service outside of the government, we're going to debit an asset of accounts receivable from the customer accounts receivable, right, of $975,300. Then we're going to debit a due from the general fund of $80,000 because we serviced our actual internal part, the general fund. And then obviously next we'll credit operating revenues, charges for sales and services for the full $1,055,300. So simple, right? We're just putting the sources from where the activity happened on the exchange transactions. The bulk of it came from customers, and a smaller portion came from the general fund. And we know the revenues was a result, it was derived from charges of sales and service. So simple, right? Not bad at all. I think these entries are a little more easy than what we were seeing in the governmental, just because of just familiarity with it, right? Did these make a little more sense, or was the other ones not too bad?
They weren't too bad, but yeah, this is pretty straightforward.
This is pretty straightforward because you're used to this now for quite some time now. Let's see here. So, assume collections from non-governmental customers totaled $968,500 for water billings. So obviously we're receiving money from customers. So cash is an asset. We debited. It's going up $968,500, and we're reducing our accounts receivable asset by crediting it customer accounts receivable for the same amount, $968,500. Simple, right? Okay, customers owing bills totaling $1,980. My gosh, not that much. $1,980. Sorry, I can't talk today. They left the village and could not be located, right? So they just bounced and left the tab, right? So the unpaid balances of their accounts receivable were written off to the allowance for uncollectible accounts as follows. So we already know how to write off bad debt, right? We're going to debit allowance for uncollectible accounts of $1,980 and credit customer accounts receivable for $1,980. And when we write off an account, why are we debiting allowance for uncollectible accounts, and why are we crediting customer accounts receivable?
Well, we're crediting receivable because that asset is going down.
Right, because when we originally made the sale, we debited accounts receivable, right? Okay. And what about that allowance for uncollectible accounts? Where did that come into play?
I'm not sure, is that some kind of contract?
It is. It is the contra account. Remember when we, just like when we levy property taxes, or when we remember accounts receivable are carried at net realizable value. It's the overall your gross receivable less your allowance, and that'll give you your net realizable value so that it's not overstated on the balance sheet. Well, that's exactly what it is. And therefore, remember, this right here will keep it from affecting revenue, right? Because we've already counted as revenue, but now we're just getting the account off the books. So, right, because we're debiting the allowance, because when we originally levied whatever those bills were, when we billed those customers, we originally credited that allowance. So we're debiting that because we don't want to interfere with revenue or anything, right? We just want to get those receivables off the books. So that's exactly what it is. I was just doing a little test there to make sure you understood why that process was happening. Okay, where are we at? Governments commonly impose impact fees on developers or builders to pay for capital improvements. These improvements could be increased water and sewer facilities that are necessary to service new developments. Increasingly, governments are using impact fees to limit sprawl and to create incentives for developers to refurbish existing commercial properties rather than create new ones. So now let's assume the Village of Riverside imposes impact fees on commercial developers in the amount of $12,500. And these fees are not associated with specific projects or improvements, right? So it's just general. They're not specifying where it's going to go, right? So we're imposing fees of $12,500. So obviously we're going to debit cash because we're getting the money, and credit capital contributions of $12,500 because it's for the purpose of refurbishing these buildings and creating new capital improvements. So that's why we're crediting capital contributions. All right, let's do a couple more here, and then we'll go ahead and call it a day. Okay, note that capital contributions is an activity account that will increase net position, but is reported separately in the statement of revenues, expenses, and changes in fund net position. So hookup fees for new customers are not capital contributions, but are exchange transactions. I think we know this because when we're providing a service there. And that's going to be included in operating revenues. If the impact fees had been restricted to a specific project, the cash would have been reported as a restricted asset. So it would have been cash restricted for whatever the relevant asset would have been. So now during 2020, the Village of Riverside established a supplies fund, and the Water Utility Fund advanced $200,000 to the supplies fund as a long-term receivable. Remember, the supplies fund received $200,000 from the utility fund, so now we're seeing the back end. We're seeing the other fund's entry here. So the entry by the supplies fund is illustrated in entry 1, the illustrative case, supplies fund section of this chapter. We've already went over that. And the following entries should be made by the Water Utility Fund. So when the Water Utility Fund sent the money to the supplies fund as a loan, non-interest bearing, they debited long-term advance to supplies of $200,000 and credited cash of $200,000. So it makes sense, right? Okay, materials and supplies in the amount of $291,500 were purchased during the year by the Water Utility Fund, and vouchers in that amount were recorded as a liability. So obviously we just bought some supplies here, debit materials and supplies because it's an original asset, so it's going up there for $291,500, and we're going to credit the liability of accounts payable because we still owe it. We haven't paid the voucher yet, so we'll credit it for $291,500. Okay, and I believe that we'll go ahead and just call this quitting for today. So Wednesday, we just have a couple more journal entries we'll go over. we'll pick back up on page 157 of the text on the top of the page and finish reading through the illustrative example of the enterprise fund and the journal entries. And then we'll get into going over the financial statements and just talk on those for a little bit as well. And hopefully we can wrap that up on Wednesday. That's my plan. And then start talking about the exam on Friday. But we might carry chapter 6 into Friday a little bit, depending on how Wednesday goes. But hopefully we'll be able to wrap that up on Wednesday, and then start looking at the exam on Friday and get that date set in stone for the following week. So that is all I have for today. I appreciate everyone's time. Does anyone have any questions with anything we covered today? Pretty straightforward. Good deal. Just remember, everybody, to please remember to do your Connect assignments for chapter 6. They will be due this Sunday, or no, I'm sorry. Yeah, this Sunday. Is that right?
Yeah.
Yeah, this Sunday. I'm sorry. Chapter 5 was due last Sunday. Chapter 6 will be due this Sunday, and we'll finish chapter 6 this week and start doing the review and do the midterm exam on probably Friday and Monday, and then we'll set the days. So remember, midterm exams on chapters 1 through 6. Get that homework in, and that is all that I have for today. Everyone have a good day. Thank you for your time.